All right, for more insight on early morning trading and what's driving these markets, Robert Schein, Chief Investment Officer at Blanke Schein Wealth Management, joining us now. Thanks for being here on this Monday, Robert. We saw yet another losing week on Wall Street last week as investors reacted to a batch of economic data. What are you expecting this week in terms of market volatility?
Well, thank you for having me. This week, it's all about earnings on the heels of Friday. And today we have bank earnings that seem to give the market lifts at the moment. But keep in mind, we're still in a bear market. So the trend itself is not how you open, even though we have a great opening this morning. It's how you close towards end of day trading. But today we got some good earnings news from the big banks. That's why we're off to the races again.
Yeah, it's all about the open, but also the closings. As you mentioned, inflation surging over 9% in June, but we got some recent retail sales data showing spending remains strong regardless. Does the stronger than expected retail data kind of calm some of those fears of a more aggressive Fed at the next meeting? We are getting some word we're going to get a 75 basis point rate hike, which has been the most aggressive thus far.
Yeah, so again, through the bank earnings, one of the things that we're looking at is how well the consumer is holding up. And according to all the surveying data that's basically being pushed through, is that the consumer is holding up rather strongly, which is providing opportunity for at least cover for the Federal Reserve to continue their march for higher rates. Now, we believe that we're going to see 75 basis points the next rate hike from the Federal Reserve, as well as a pause. Obviously, we've got a month off in August for the Fed to obviously sit down and wait and see. But ultimately, if you look at the last, going back to 1974, the last 8 tightening cycles of the Federal Reserve, they don't stop tightening until the Fed funds rate is well above the CPI rate. And keep in mind, the CPI rate right now, as you just indicated, is 9.1%, and the Fed funds rate right now is 1.8%. So there's a lot of work that needs to be done by the Federal Reserve. So they don't have the opportunity to push pause. They have to continue raising interest rates, even though we might be in the, there's talk of a recession ahead in 2023.
You mentioned they don't have the opportunity to push pause at this point, but there have been analysts on the show who have said the Fed is being way too aggressive. This could push us into recession territory, especially as we know there are so many different factors tackling the economy at this point that are outside of the Fed's control. And a lot of these policies take, in some instances about a year to leak into the market. How do you think the Fed has been moving right now? Do you think it's the right pace to tackle inflation, regardless of what they actually do? Do you think this is the correct strategy that the Fed should be deploying with going more aggressive moving forward?
Well, what we're seeing is, especially now, the economy itself globally is moving quicker and faster, right? And the Federal Reserve is slow and measured. And so at the very beginning, they were behind the curve, clearly. They called inflation transitory. Now we're in the camp of, or at least they're now coming to the realization that, there's a lot more stickiness with regards to housing as well as wages. And that's the concern as inflation is broadening through the balance sheets and consumers. So inflation is here to stay. We're seeing it all over from the kitchen table to the earnings. And I think that the key this week to pay attention to are earnings, what the companies actually guide. So the guidance, what they say, because corporations are still holding up on the top line relative to the bottom line. It remains to be seen in how they report. And then the second big thing this week is what we're paying attention to at Blanke Schein Wealth Management is housing. And so that was what the Federal Reserve is trying to ultimately slow down. They went after the stock and bond market 6 months ago by trying to pump the brakes in the economy. Obviously, we've seen $2 trillion come out of the cryptocurrency market, and now housing is square in the sights of the Federal Reserve. So housing data this week, as well as corporate earnings and what they guide going forward, is going to be the week ahead that we're going to be paying attention to.
I think that's really good advice for investors out there, especially as you mentioned, earnings beats on tops and bottoms can look really good, but guidance moving forward is what a lot should be kind of focusing on at this point. And speaking of earnings, we mentioned the last of the bank earnings coming out this morning, Goldman Sachs, Bank of America. I'm wondering if you can kind of weigh in on your takeaways from both of these very different results. Goldman Sachs really higher, closing higher, also up in pre-market. Bank of America a bit more mixed. What are you watching in this sector?
Yeah, in the banking sector, you're seeing a relief rally, and you have to continue to watch. It's great to see, on the Goldman balance sheet, a lot of expense sort of savings there. So they, really did a good job on internally. And then, again, it's the consumer to see, we can't have bank earnings continue when you have an inverted yield curve. So that can persist longer. And right now we've got twos above the tens. And so that's not good for earnings going forward in the financial services sector or even bank sector. So that can't persist. Again, that's a recessionary indication on the dashboard that we're paying attention to. So again, the economy is slowing. The Federal Reserve's got a window of opportunity to get the job done. And then I think it's going to be a pause and wait and see environment, which then sets up well in the back half of the year for equities.
Yeah, and why exactly are these bank earnings so important, especially right now? What is it about the consumer picture that we're getting that's important information for people to take notice of?
Yeah, bank earnings are, again, a pulse on credit card spending on the consumer itself. And ultimately, one of the reasons why we had an issue here with regards to inflation or runaway inflation for the most part is because consumers have, over $2 trillion in their balance sheets, ready, willing, and able to basically start deploying. And so 2/3 of our economy is all about the consumer. So we always pay attention to how banks are reporting what consumer behavior is, and consumer behavior is going to shift. We're going to get an indication of, the balance sheet from savings depleting on the consumer balance sheet to then consumer sort of credit increasing. And that's not a good sign. That's a good sign for the economy to continue. But we do need sort of the spending to slow down a little bit because there's too many dollars basically chasing too few goods and services. So that's what the Fed's trying to work on. But yeah, we have to pay attention to the bank earnings because they tell us a lot about the consumer, and that's 2/3 of our economy.
All right. And we're also set to get earnings from a slew of other big companies, including Netflix, Tesla, Twitter. What are you expecting from these blue chip stocks, especially during a year where we've seen a lot of investors move away from growth stocks, those that aren't showing the valuation and dividends, the return on these investments, especially during this really volatile time?
Yeah, so what we've done and the advice that we've given to our clients at Blanke Schein Wealth Management is we're balanced, we're diversified. Again, we like the healthcare sector as well because it pays dividends. The value has outperformed growth, as you just pointed out. And this week, growth, especially companies that are in the growth category that actually produce earnings, whether they deploy them by way of dividends or not to their end shareholder, you really want companies that have top line earnings and bottom line earnings as well. So that, just solid companies. You're seeing the companies that are, tech light that have no earnings, 2020, if you will, those have really gotten damaged and hit tremendously year to date. So that's kind of too much of a, I guess, that's not where we spend our time paying attention to. We just like high quality companies that produce a cash flow, and especially if they have a dividend. That's a good place to hide out when you're in a bear market, as we are still. Keep in mind a couple of technical levels we're going to pay attention to too, as well as the S&P 500. Although we're having a rally, it really remains to be seen if we can, basically close above the 50-day moving average for the S&P 500. Right now, that's 3928-ish. And so we could see a rally all the way from where we are today and then test the 50-day moving average on the upside. And that's really going to give us an indication is, where we are in the cycle and if we can, move our way higher from there.
Something we're also watching right now is the job market, which a lot of experts have told us thus far has been relatively healthy right now. But Goldman Sachs is putting out a warning that the job market is poised to slow, quote, sharply in the coming months. Do you agree with the forecast, and what could that mean?
Yeah, historically speaking, we haven't had a technical recession or recession without the job market basically turning over. And yes, we see that. I mean, everything that we read, especially from the Wall Street Journal, the corporate earnings, and just the announcements out of Silicon Valley, we're seeing either hiring freezes or laying offs. And so corporations are slowing down. We saw this in 2000 as well. In March of 2020, we had the highest print, over 400,000 jobs printed back then. And so that was a hot job market. And then what happened is we had the markets basically and the economy roll over. So the job market is a lagging indicator. And so we believe that right now in today's, job markets, I think we're going to see corporations slow down for expense purposes, as well as to see where the economy moves forward. So that's going to work its way into the job market, sort of easing up, and that tightening to basically easing cycle for the job is going to be better for the economy. It's going to be better for the Federal Reserve. So that's exactly what needs to happen. So we anticipate that the job market could be slowing down a little bit moving forward.
So to piggyback on that note, really good information, but what should investors be doing during this time as they are preparing for a slowdown in the job market? Are there specific sectors where you're expecting this to happen first? We've already kind of seen it start within the tech area, crypto. Where else do you think this can pop up soon?
Yeah, so investors very specifically should be using this opportunity in markets like today for upgrading their portfolios. Everyone has an opportunity in their investment account in their portfolio to say, hey, listen, this was a good idea at the time, but the economy's shifting and the markets are shifting. So what can I sell today and then buy something that's down right now at a good quality? So diversify, dollar cost average, and upgrade the portfolio to higher quality, because you don't know how long or how deep a recession could be moving forward. But what you do know is those companies that have large balance sheets, quality, corporate America guidance, if you will, in terms of management teams, those will not only get bigger and stronger, but they'll thrive once we get through recessionary periods of time. So it's an opportunity to upgrade your portfolio. It's an opportunity to say, hey, listen, what's working, what's not, but don't miss this opportunity when the markets are down. Essentially, everything's on sale, to look at what you would want moving forward.
Yeah, some say that you build your wealth during a recession. I also want to get this last question in about gas prices. They've been on a steady downturn over the last 30 days in a row, extending their longest decline in over 2 years, something that a lot of Americans love to see, especially right now in this inflationary environment. But what do you think that says about the future moving forward? Does this decline continue, and how does it impact the entire inflation dynamic?
Yeah, you saw a broad-based commodity sell-off with a couple other indications this last 30 days plus. Obviously, metals and a few others, again, flashing the signs on the dashboard of a global recession. And don't forget the strong dollars in there as well, which is also going to hurt global markets, or at least global economy versus the United States. But going back to oil very specifically, as I always talk about, it's about the kitchen table economics. So the consumer has less. Energy is going to be persistently higher for longer, simply because the structural long-term setup of both policymakers in the United States and globally. We're not ready to flip the switch tomorrow to energy independence. We'd all love that to happen. We'd love to get there, but there has to be a time and place for sort of a hybrid approach and getting that sort of transition over time. And so in the short term, U.S. kind of stubbed their toe right now because our energy independence. We could be producing, right now there's a net deficit of 3 million barrels a day on the global market. And let's say we go into a global recession, that's 2 million barrels a day that we're still going to be at a net deficit. And that's by OPEC. That's their own report last week. So we've got the only thing that could actually help oil is if we go into global recession, but it's still not going to be as much as we need. So we're at a net deficit in terms of global production worldwide in terms of production. So it's just a classic supply and demand story. So oil right now is trading down. It's great for the consumer to feel that, especially a holiday travel season or a summer travel season. But longer term, I think oil is going to be, stronger and higher from here.
Again, lots of good information. So good to have you on the show. Thanks again. That's Robert Schein, Chief Investment Officer at Blanke Schein Wealth Management.